Hey, this is Tom Nash, and let's talk about the future of Palantir. And I'm going to guarantee something here. A lot of you are not going to like to hear what I have to say about this company. Now, look, when Dan Ives, the famous Wall Street analyst, went on TV and he called Palantir the Messi of AI, everybody got excited overnight. And if you were one of those people who bought a lot of Palantir shares on the frenzy out of FOMO, on the eve of Dan Ives, Palantir slash Messi craziness, then you deserve to get hammered. Because everybody who chased this stock and FOMOed into it on that $20 price and went balls deep into the stock without understanding what they're doing, they got destroyed by professional traders. And you know what? They deserve that same fate every single time. Chasing, FOMOing, fear of missing out, into stocks without understanding what you're doing is a bad idea. Buyers of $20 per share Palantir shares went absolutely horribly destroyed by professionals, by traders, by people who knew what they're doing in just a matter of 2 days. Don't ever chase stocks. Don't ever FOMO into stuff without understanding what you're doing. Now, what happened with Palantir? Why did it drop 20% in a matter of 2 days? Well, first of all, earnings were not bad. Earnings were actually in line with expectations. But, the stock still dipped quite heavy, as you can see here on the screen. So what happened? Well, number one, we had a lot of macro issues, which I covered before in the previous video. Moody's, the credit rating agency, came out and said, well, we're looking forward to a recession in 2024, and that had to be priced in. But that wasn't the sole factor that drove the share price down. Obviously, there was a little bit of disappointment from the earnings. Now, Palantir had solid second quarter earnings, no doubt. Very exciting stuff about the AIP platform. Very interesting, future-facing, potential mind-blowing stuff we heard from Alex Karp's team. But there was never anything absolutely mind-blowing from a fundamental perspective on the numbers, similarly to what we had with NVIDIA. The management then came out and said, hey, we're expecting 100% growth next year. Nothing cataclysmic like this happened that drove the share price up. And that obviously was not also expected, but when it happens, you see the NVIDIA level spike. What we got was a decent quarter, a very good quarter on the numbers side. 13% up in revenues, 50% up in billings, guidance for $2.2 billion this year. Revenues, I wish it was 2.2 trillion. It's a 16% annual growth, actually faster than currently, which means acceleration in the future quarters. A very good balance sheet, still stays intact with $3 billion in cash, no debt. So where is the problem? Where's the disappointment? Well, it's more on the narrative side. Well, number one, we had the share buyback announcement. Palantir comes out and said, hey, we're going to buy back $1 billion worth of shares. And that's very exciting because Palantir is actually talking the language of the institutional shareholders, which they're so much interested in attracting to the stock. Instead, they got a lot of retail traders, opportunists, speculators. They want the steady, solid institutional investors in the game. So a share buyback is actually a good way of doing this. The company buys back its own shares, pays shareholders money, and that also is a signal that the company thinks that the intrinsic value of shares is very low. Now, obviously, the criticism from Palantir here came from the point of, look, you guys could have done this at $7 per share. You will be doing this now at $15, $16 per share. It makes no sense, and people get upset about it. But the fact of the matter is you have to understand that buybacks are a psychological move. You want to transmit and project strength. If you're doing buybacks when your share dropped from 35 to 7, you're basically transmitting and communicating fear and panic. You're trying to artificially inflate the share price. When you're doing this, coming off of a 180% swing year to date, that's coming from a place of strength. That's the right way to do it. Theoretically, if you could have done it at $7 and actually still project strength and not weakness, sure, but there was no way to do it, so I have no issues with what I done here. Now, the company also mentioned multiple times the S&P 500 probable inclusion at the end of the year when they actually hit 4 consecutive quarters of GAAP profitability. Palantir meets all the conditions for the inclusion except that 4 quarters of consecutive profitability on the generally accepted accounting principles. Now, obviously, they've mentioned this multiple times, and there were a lot of criticism from investors that said, look, why are you hyping this up? And I never understood that criticism because this is a huge deal. Look at what this inclusion did for Tesla. It's a major, major event. It proves that this is a huge deal and they were right to talk about it. Again, I also never understood the part where these guys were complaining last year that Palantir was not speaking the language of Wall Street and was not speaking the language of institutional investors. And now that they're doing this and they're talking about the inclusion, they get criticized for it. It's actually very funny to me. Now, there was also lots of criticism for the growth of the company and the net dollar retention. So the business, if you segmented, grew 15% on the government side, 10% on the commercial side, combined 13%, and there was 110% net dollar retention, which is a decline. Now, if you look at Snowflake, they're operating at 180% net dollar retention, absolutely insanely better than Palantir. Now, what you have to understand is comparing the Snowflake retention to Palantir retention is not a good comparison because Snowflake is selling kind of a low tier item, more in the consumption side. Palantir is selling a high ticket item. It's a very different business, but also the strategy here plays a huge role. Palantir has completely shifted its strategy of the past 2 years, basically going from a place of trying to grab as much as they can into this Trojan horse kind of pricing model. You get in, you underprice, underperform, you loss leader your way into a business, but then when your product becomes sticky enough, you raise the prices and actually generate cash flow, revenues, and profits. I mean, that's currently misunderstood by the markets, but it will be understood when they see the reveal, when that aha moment happens in 3, 4, 5 years, whenever Palantir does that pivot. But again, Wall Street media and CNBC and all the talking heads, they're not going to get it until they see it clearly in the financials, which will take 3 to 5 years. And by that time, Palantir is going to be trading at a lot higher multiples. And that's why they will miss the boat on this. And that's okay. They always do. But look, if you want a hint at how quickly Palantir is growing behind the scenes, look at the customer count. Customer count went up by 38% year over year this quarter. That's not something you see every day. Customer counts going by almost 40%. Now, another issue that we have to talk about that kind of puts a damper on the Palantir numbers is the stock-based compensation, the options, the RSUs that they're giving out to employees. Now, look, this is another case where retail investors have done a much better job than institutional investors at analyzing what's actually going on here. You see, if you look at stock-based compensation for Palantir as a percentage of revenue, what you learn is something very interesting. You learn that the stock-based compensation in Palantir in Q4 of 2020, 3 years ago, was 75%. So 75% of revenues went to stock-based comp. Currently, this quarter, we're at 21.4% according to Emir M, my friend from Twitter. I want you guys to go and follow him. He does one of the best charts of Palantir. In fact, I once saw his chart and I thought it was an official Palantir chart. It was that good. So he shows this beautiful chart how stock-based comp is coming down every single quarter. For the past 2 years, every single quarter, it's coming down. It's currently at 21.4%. Now, the thing is that 21.4% is literally on par with the rest of the industry. So there's no complaint currently to the stock-based compensation of, component of Palantir. So that's old news. That's kind of a rehashed, regurgitated argument. Now it doesn't really make a lot of sense. At 21% of revenue, that's absolutely normal. Look at Snowflake, look at others. Now, there's another complaint here about client concentration. Look, the top 20 clients of Palantir drive half their business, about $1 billion. The other 400 clients are responsible for the other billion. So it's a valid point. When all of your business is concentrated in the hands of a few clients, that's risky. I get it. It's a valid point. But you have to understand that the percentage of overall revenue actually went down. So the top 20 clients gave you about $470 million in 2020. They currently give you $1 billion, but they're currently 51% of revenues. Back in 2020, they were 61%. So you see this thing where the revenue for the top 20 clients keeps climbing from 470 million to 1 billion within 3 years. But the percentage of revenue is actually going down from 61% to 51%. Again, this beautiful chart is from Emir M. Go follow him on Twitter. So stock-based comp is one thing that's regurgitated. Client concentration is a valid point, but look, they are getting better at this. And also, not every company can drive $1 billion from 20 clients. It's proof that their largest clients are spending more and more every year. In 3 years, they went from 500 to $1 billion. So they've doubled the spend for the top clients. That means that the products and the services are sticky. They're spending more every year. It's not a huge issue if the trend line is going up. It's a major growth catalyst for the company. Now, RPOs is another thing where Palantir also gets hammered. Its remaining performance obligations, it went flat. Sure, it was 550 million in Q3 last year. It's currently 560 million, so it's pretty much flat. But another thing that gets missed here, look at the trend. That we had 370 million in RPOs in Q4 of 2022. So we went from 370 million in Q4 of 2022 to 560 million right now. Look, it's a huge hint about where the future growth of the company is going to be at. So as RPO is starting to trend upwards again, and yes, sure, they're not trading up in a huge pace, but they are trying to reverse the course from 370 to 560 million. That's a good sign as far as the future revenue growth. Now look, can Palantir potentially fall even lower? Yes, it can. It's possible. Can they drop to $7 per share? I would say probably not. Can they drop to 13% per share? Definitely. So just a word of warning here. The same people who were FOMOing into the stock at $20, buying it blindly like crazy, are going to be punished if they try to catch this. Now, catching a falling knife and FOMOing into a hype stock is two sides of a horrible act that you should never do as a long-term investor. I don't know how low Palantir can go in these circumstances, and trying to catch it now to make a quick swing, it's not a good idea. Now look, Palantir has been my biggest position for years, since 2020, and it's not going to change unless something dramatic happens about this company that changes my thesis absolutely completely, right? I look at the company and I see strong financials, strong foundations, balance sheet, clean as a whistle, $3 billion in cash, no debt. I see GAAP profitability for 3 quarters going on 4. I see 80% gross margin. I see double-digit growth in a horrible year where companies were busy spending less, not spending more. I see AI segment being dominated by Palantir. Again, something that's completely missed by mainstream media. I see a massive government business that's going to drive dollars to Palantir in every economy. Not only that, it's going to prove the concept to commercial clients, and it creates a huge network for Palantir for influence and cloud. I see a sticky business. Look at their top 20 clients. They went from spending 470 million to over 1 billion in just 3 years. I see Palantir quasi-monopolizing this whole foundry business and Gotham, and not even to mention AIP. So I see Palantir as a company in pre-growth jump. So basically what I see is that Palantir hasn't done its growth jump yet. It's not even there yet. It's kind of ramping up, amping up. And that means that the road ahead until that jump happens is going to be very treacherous and very painful. And, look at the stock. It's up 140% year to date still, even after that 20% correction. With the exception of Snowflake, it's still expensive, very expensive compared to the segment. It still has very low institutional shareholding with 35%. Buybacks is a step in the right direction. S&P 500 inclusion is another, but there's still a long ways to go to 60% institutional shareholding. Macro is still very shaky. Moody's predicting a recession. Who knows? There's lots of traders in this stock, guys. Lots of speculators, lots of short-term money that's going to punish you if you try to play their game. Their game is short. Your game has to be long. But there's good news. And the good news is that every single bear of Palantir says the same goddamn thing. I believe in the long-term business, long-term story of Palantir as a leader in AI. I just don't like the share price. So there's not a single bear out there that's saying that Palantir is a bad business, that's saying Palantir isn't going to dominate. All of them are saying Palantir is a great business. It's just trading at a higher multiple than I like. That means that the long term of this company is very, very bright. It has a bright future. So long-term investors in Palantir will be rewarded. Short-term investors that flip the switch and try to trade it are going to be punished. So the way to do it, and I'm going to sound like a broken record now. The way to do it correctly is by basically going out and buying a little bit of shares every single week, every single month, every single quarter, whatever suits you, and buy it at a very slow pace because you got 3 to 5 years to invest in the stock. There's no rush. Just buy it a little bit every week. And when it goes up, you buy a little bit less. When it goes down and it dips 20% 2 days, you buy a little bit more. It's very, very simple. You want to learn a steady system how to do it? Well, there's a DCA system which we employ and which we teach on our Patreon page at patreon.com/Tom Nash. We teach a DCA model that uses the 52-week high. We look at where the company was at the 52-week high, which is $20. We look at 10% below that, which is $18. And when the share price is below $18, we buy more. When the share price is above $18, we buy less. That's kind of the gist of it, but there's a lot more that goes into it. If you want to learn the system, join our Patreon, patreon.com/Tom Nash. You can try it out. Join our Discord, 5,000 members. Absolutely insane. I'm so blessed and thankful for that. Very, very proud of the community. Join our community. The link is going to be below in the description. It's going to be in the pinned comment below. Shout out to the Palantir community, to the true long-term investors. And those of you who got punished short-term trading the stock, I hope you learned a lesson. I'll see you in the next video. Have a great weekend.